What are Treasury funds? Treasury bond funds or Treasury funds are mutual funds that invest primarily in United States Treasury bonds, which are marketable income-producing debt securities issued by the United States government. Since Treasury bonds are backed by the creditworthiness of the U.S. government, most investors consider Treasury funds a safer bond fund choice than corporate or municipal bond funds. Treasury bonds, however, have maturity dates of 10 years or more, making Treasury funds vulnerable to future price swings, prepayment risk, interest rate changes, and default risk. The duration of a Treasury fund can be calculated by finding the weighted average of the time left to the maturity date of each bond in the fund. Treasury funds produce a rate of return that is determined by both the change in the net asset value of the bonds and the value of the interest distributions paid out semi-annually. Interest rate decisions made by the Federal Reserve directly impact the net asset value of government bond funds, especially those containing mortgage-backed securities issued by government lending agencies, Treasury bills, notes, and other securities with maturity dates less than 5 years. The prices of long-term Treasury funds tend to be market-driven. In 2010, Treasury funds posted returns as high as 10%, while the short-term funds only performed as high as 4%. Intermediate funds with maturities of from 5 to 10 years yielded from 2 to 5% in 2010. The U.S. government auctions Treasury bonds through non-competitive and competitive bids. For non-competitive bids in which the bidder accepts a set rate, the maximum purchase amount is restricted to $5 million US. In competitive auctions in which bidders submit rates that they are willing to pay, the maximum allowed purchase is up to 35% of the entire offering. Treasury funds not only contain Treasury bonds but also some other Treasury securities with longer durations. Many Treasury funds strive to outperform the long Treasury bond index, including Vanguard Long-Term US Treasury, T. Rowe Price US Treasury Long-Term, and Dreyfus US Treasury Long-Term. Some government bond funds provide protection against inflation in the U.S. economy. In these funds, the rates of return or the principal amounts are linked to the rises and falls in the inflation rate. Different funds offer different inflation protection strategies, making the rates of return variable from fund to fund. Investors should be aware that taxes apply not only to the income of the fund but also to any adjustments made to the principal.